We speak of black swans. We model tail risks. We build portfolios designed to weather the 100-year storm. But the truth is, the ink in our modern ledgers is haunted. It is haunted by the ghosts of economies past, by the faint spectral entries of bookkeepers and quartermasters who faced their own 100-year storms, their own black swans, their own climate-driven systemic shocks. We are not the first to attempt to price the apocalypse. We are not the first to stare into the abyss of environmental catastrophe and ask a simple, terrifying question. What is this going to cost? The story of finance is often told as a story of progress, of ever-increasing sophistication from barter to blockchain. But this is a dangerously linear narrative. I propose a different view, a view that sees financial history not as a straight line, but as a spiral. The same fundamental challenges return, cloaked in new technology, but with the same brutal core. The ghost in the ledger is climate. It has always been there. An invisible variable on the balance sheet, a silent partner in every transaction. A creditor who, eventually, always calls in the debt. Today, we call this climate risk. We quantify it with ESG ratings. We model it with integrated assessment models. We try to hedge it with catastrophic bonds and weather derivatives. But what if I told you the fundamental principles of these instruments, the very human impulse to mitigate environmental volatility, are etched into clay tablets from the Bronze Age? From that the debates we have today about fiscal response and monetary policy in the face of systemic shock echoed in the marble halls of the Roman Senate. This is not merely an academic exercise. This is about understanding the deep historical precedent for our current predicament. It's about recognizing that the financial tools we believe are uniquely modern are in fact echoes of ancient strategies for survival. We are tasked with managing the most complex and interconnected global economy in history, facing a climate crisis of unprecedented scale. To do so effectively, we must become financial archaeologists. We must learn to read the ghosts in the ledger. Let us begin our excavation in the sun-baked world of the late Bronze Age, around 1200 BCE. This was a world that would have felt, in some ways, remarkably familiar to a modern globalist. It was an interconnected network of great powers, not the Egyptians, the Hittites in Anatolia, the Mycenaeans in Greece, the Babylonians. They were linked by sophisticated maritime trade routes crisscrossing the Mediterranean, a true globalized economy for its time. Raw materials like copper from Cyprus and tin from Afghanistan traveled thousands of miles to be forged into bronze, the bedrock of their military and economic power. The ledgers of this era, painstakingly inscribed in cuneiform on clay tablets, tell a story of breathtaking complexity, of bills of lading, of debt agreements, of royal inventories and international trade treaties. This was a system built on stability. It was a system built on predictable harvests and open sea lanes. It was a system utterly unprepared for a systemic shock delivered by climate. Then the ghost stirred. Paleoclimatologists, analyzing everything from pollen data in Syrian lake beds to stalagmite growth in Mediterranean caves, have identified a period of abrupt, severe, and prolonged drought that began in the centuries after 1200 BCE. This wasn't just a bad harvest year. It was a climatic regime shift. The established patterns of rainfall that had supported intensive agriculture for centuries simply broke down. This climatic event is what many scholars, including Eric Klein in his seminal work 107 BC, identify as the primary catalyst for the Bronze Age collapse. So what does the financial response to this look like on a clay tablet? It looks like desperation. We see it in the frantic correspondence between kings. The king of Ugarit, a vital port city in Syria, writes to the king of Alashia in Cyprus, pleading for grain, writing, "My country is starving." It's a message that is both a humanitarian plea and a notice of impending sovereign default. The entire economic system was predicated on a grain surplus. Without it, the palace economies, which function as centralized hubs of redistribution, failed. They couldn't pay their soldiers, their artisans, they're bureaucrats. The ledgers show a breakdown in the most fundamental asset valuation. The value of bronze, the era's key industrial commodity, was predicated on a complex supply chain. When the sea lanes became insecure due to piracy, itself a symptom of economic desperation as coastal communities could no longer sustain themselves through farming and fishing, that supply chain fractured. The cost of tin skyrocketed. The ability to produce bronze and therefore military power and agricultural tools plummeted. We see the ghost of this in the archaeological record, a dramatic increase in the hoarding of scrap metal, a desperate attempt to preserve value as the formal systems of exchange collapsed. This was their version of a flight to hard assets. This was not a system that had any concept of insurance or diversification. The palace economies were monolithic. Their risk was entirely concentrated in a single agricultural model and a single international trade network. When the climate pulled the rug out from under both, there was no financial resilience. There was no plan B. The response was not a managed deleveraging or a structured workout. It was a catastrophic, cascading failure. Debt went unpaid, treaties were broken, cities were abandoned. The intricate web of credit and obligation that held their world together simply dissolved. The lesson from the ashes of Mycenae and Ugarit is a brutal one. Hyper-efficiency and interconnectedness, without built-in redundancy and diversification, create a fragile system. The ledgers, now silent, are a testament to a financial world that failed to price in the true cost of a stable climate and paid for it with extinction. This was the first and perhaps most total encounter with climate's ghost in the ledger. Now let us move forward a millennium to an empire that represents the pinnacle of ancient economic organization, Rome. If the Bronze Age shows us the consequences of systemic fragility, Rome offers a different, more complex lesson. It shows us a state actively using monetary and fiscal policy to combat crisis, including crises with clear climatic drivers. The Roman economy was built during what is now called the Roman Climate Optimum, a period from roughly 200 BCE to 150 CE characterized by unusually warm, wet, and stable weather across the Mediterranean basin. This stability was a hidden subsidy. It guaranteed predictable, surplus harvests of grain, grapes, and olives, the holy trinity of the Roman economy. This surplus was the engine of empire. It fed the legions, it fed the capital, and it allowed for an unprecedented level of economic specialization and trade. The Roman state, in its wisdom, developed financial mechanisms to manage this system. The annona, the grain dole for the city of Rome, was not just a welfare program. It was a massive logistical and financial operation, a strategic commodity reserve designed to smooth price volatility and ensure social stability. It was, in effect, a state-run insurance scheme against localized harvest failures. For centuries, this system worked. The denarius, a silver coin of high purity, became the reserve currency of the Western world, a symbol of stability and trust. But then, the climate changed. The period after 250 CE, and more dramatically during the late antique Little Ice Age from about 536 to 660 CE, saw a return to volatility. Volcanic eruptions, including a massive one in 536 CE that shrouded the hemisphere in dust, and a general cooling trend led to widespread crop failures, famine, and plague. The hidden subsidy of a stable climate was withdrawn. How did the Roman financial system respond? This is where the ghost appears in the imperial ledger, and its response is eerily familiar. Faced with declining tax revenues from failing farms and the ever-increasing cost of a massive military, emperors resorted to monetary debasement. The silver content of the denarius, which was over 95% pure in the time of Augustus, plummeted. By the mid-3rd century, during the height of its crisis, the primary silver coin, the Antoninianus, was often a bronze core with a microscopic silver wash. It was a desperate, short-term fiscal response. This was Rome's version of quantitative easing. They were printing money to cover their deficits. The immediate effect was hyperinflation. The cost of goods spiraled out of control. We have records like Diocletian's edict on maximum prices from 301 CE, which was a futile attempt to impose price controls on everything from wheat to lions, a clear signal that the state had lost control of its own currency. Trust in the financial system evaporated. People began to hoard older, purer coins and reverted to barter. The complex monetized economy began to break down. Another financial response was a radical restructuring of agricultural production. As small farms failed, they were absorbed into vast estates called latifundia, owned by the wealthy elite. The peasants who once owned this land became colony, tenant farmers, tied to the land by debt and law. This was a risk management strategy for the elite. It guaranteed them a labor force and insulated them from the volatility of the wage labor market. But it was also a profound economic regression, a step away from a dynamic market economy towards the rigid, localized system that would characterize feudalism. They were trading economic dynamism for a brittle form of stability. The Roman case is a powerful historical precedent. It demonstrates how a sophisticated economy, when faced with a prolonged environmental shock, can resort to monetary louis and fiscal tools that ultimately undermine its own foundations. The debasement of the currency and the creation of a permanent, land-bound peasant class were not just symptoms of decline. They were financial responses that accelerated it. They chose short-term solvency over long-term sustainability. The ghost in their ledger warns us that when the fundamental productivity of the real economy is compromised by climate, financial engineering can quickly become a tool of self-destruction. The value of an asset, whether it's a coin or a bond, is ultimately tied to the productive capacity of the world that underpins it. When that world falters, no amount of monetary manipulation can preserve its value indefinitely. Let's sail north to a colder, more marginal world. The story of the Norse Greenland colony, which lasted from roughly 985 to 1450 CE, is a perfect tragic microcosm of a society whose economic model was completely annihilated by climate change. It is a case study in the mortal danger of stranded assets. When Eric the Red and his followers settled Greenland during the medieval warm period, they brought with them a European economic and agricultural package: cattle, sheep, and a social structure based on dairy farming. For several centuries, this worked. The climate, while challenging, was just warm enough to allow for the growth of enough fodder to sustain their livestock through the long winters. But their economy was not purely subsistence. It was an export economy. Their connection to Europe, and their primary source of wealth, came from luxury goods they could extract from their environment. Most notably, walrus ivory and polar bear pelts. Walrus ivory, in particular, was a highly prized commodity in medieval Europe, used for luxury items like crucifixes and chess pieces. For the Norse Greenlanders, this was their crude oil, their diamond mine, their entire financial model, their ability to import essential goods they could not produce themselves, like iron, timber for shipbuilding, and ecclesiastical goods, depended on the stable price and reliable extraction of this single asset class. The ledger was almost entirely balanced on the tusk of a walrus. Then, starting in the 13th and accelerating in the 14th century, the climate began to cool with the onset of the Little Ice Age. This was not a sudden catastrophe, but a slow, grinding systemic shock. The growing seasons in Greenland became shorter. Hay production fell. Supporting a herd of cattle became increasingly difficult, then impossible. Archaeological evidence from their rubbish heaps, their middens, shows a desperate dietary shift over time. The bones of cows and sheep become rarer, replaced by the bones of seals and other marine life. They were consuming their capital stock. Simultaneously, their primary export was hit by two external shocks. First, the expanding sea ice made the voyage to Greenland more treacherous, and the walrus hunt itself more dangerous and less predictable. Their supply chain was literally freezing over. Second, new sources of elephant ivory began flowing into Europe from Africa, competing directly with walrus ivory and depressing its price. The Norse Greenlanders were caught in a perfect economic storm. their domestic agricultural system, their primary means of subsistence, was collapsing due to climate change. Their export commodity, their only link to the global economy, was becoming both harder to produce and less valuable. Their entire economic model had become a collection of stranded assets. Their farms, their cattle, their knowledge of European agriculture, all were rendered nearly worthless by the changing climate. The walrus hunting grounds, their primary source of foreign currency, were increasingly inaccessible and facing new market competition. What was their financial response? The heartbreaking answer is that there wasn't one, or at least not an effective one. There is no evidence that they adapted their technology or their economic model in any fundamental way. They did not adopt the superior sea mammal hunting techniques of their Inuit neighbors, who were thriving in the cooling climate. They did not fundamentally restructure their society away from the European farming model that was so clearly failing. Their response was essentially a slow-motion, society-wide default. They clung to an asset valuation and an economic identity that no longer matched the reality of their environment. The last written records from the colony are sparse, detailing marriages and property disputes. The ghost in their ledger is a ghost of silence. It's the sound of an economy contracting, of a balance sheet shrinking to zero, of a society slowly starving and freezing in the dark, clinging to a model that had long since failed. The lesson from Greenland is stark and profoundly relevant to our discussions of stranded assets today. It is a warning against cultural and economic inertia. The Greenlanders' identity was that of European Christian farmers. To abandon that model, to adopt the ways of the Inuit, would have been, for them, a form of civilizational death. And so they chose literal death instead. Their story is a chilling reminder that when the underlying environmental fundamentals change, a refusal to reassess the value of your core assets and adapt your economic model is not a strategy. It is a death sentence. It shows that the most dangerous entry in any ledger is the one that reflects a value based on yesterday's climate, not tomorrow's. Our final excavation takes us to the heart of medieval Europe, an economy of far greater scale and complexity than Norse Greenland. The Great Famine of 1315 to 1317 was a cataclysmic event, a systemic shock triggered by an almost unimaginable stretch of cold, rainy weather. It began with torrential rains in the spring of 1315 that simply did not stop for 2 years. Fields were flooded, seeds rotted in the ground. The harvest failed, not just in one region, but across almost all of Northern Europe simultaneously. The scale of the crisis was unprecedented. This was a complex feudal economy with interlocking systems of manorial obligations, nascent commodity markets, and the powerful financial influence of the church. So how did this system respond when its agricultural base was washed away? What does the ghost in the manorial account book tell us? The first and most immediate response was a catastrophic price shock. Grain prices exploded. In England, wheat prices rose by more than 300% in a single year. We have detailed records from places like the estate of the Bishop of Winchester, which show the frantic attempts of manorial lords to manage their dwindling supplies. This wasn't a simple supply and demand curve. It was a vertical line of desperation. Those with grain hoarded it, speculating on even higher prices. Those without starved. Estimates suggest that 10 to 15% of the population of Northern Europe perished. What financial mechanisms existed to cope with this? There was no formal insurance market, no catastrophic bond to be triggered. Risk was managed primarily through two means: storage and charity. Manorial lords and monasteries maintained granaries, designed to buffer against a single bad harvest. But no one had a buffer for 3 consecutive failed harvests. Their risk management models were simply not built for a shock of this magnitude. The church, as a major landowner and financial institution, played a critical role. It was the lender of last resort and the provider of what little social safety net existed. Monasteries opened their granaries to the poor, but these were quickly exhausted. The church also engaged in debt relief, but this was ad hoc and inconsistent. The ledgers of the time reveal a massive spike in debt. Peasants desperate for seed to plant for the next year or for food to survive the winter, mortgaged their future labor and their small plots of land to their lords or to emerging moneylenders. This created a cycle of debt peonage that would persist for generations. The famine acted as a massive wealth transfer mechanism from the small producer to the large landowner. The financial response, driven by desperation, was to sell one's future for a chance at immediate survival. This period also reveals the tension between a market economy and what historians call a moral economy. There were widespread riots and attacks on merchants and speculators accused of price gouging. There was a powerful social belief that in times of crisis, community needs should supersede individual profit. Kings and lords attempted to impose price controls, much like Diocletian in Rome, and like him, they largely failed. The market, even in its medieval form, was too powerful. The Great Famine is a powerful lesson in the financial consequences of a correlated, systemic shock to the food supply. It demonstrates that even a relatively sophisticated and geographically diverse economy can be brought to its knees when a single essential sector fails everywhere at once. It shows the limitations of traditional risk management, like storage, in the face of an unprecedented event, and it reveals the brutal social consequences of a crisis where the only available financial tools are high-interest debt and insufficient charity. The ghost in the medieval ledger is one of extreme price volatility, massive, unpayable debt, and the grim accounting of starvation. It warns us that when a system's core commodity is threatened, the financial instruments built upon it can become tools of exploitation rather than relief, accelerating social breakdown. So we have unearthed these ghosts from their ledgers of clay, papyrus, and parchment. What do they tell us, the financial stewards of the 21st century? It is tempting to dismiss these stories as ancient history, irrelevant to our world of algorithmic trading and complex derivatives. This is a profound mistake. The operating system has been updated, but the source code of human and economic response to environmental crisis remains dangerously unchanged. The Bronze Age collapse is a stark warning about supply chain fragility and the perils of over-optimization. Their interconnected world, so efficient in the good times, was brittle. It shattered because there was no redundancy. Today, our just-in-time global supply chains are infinitely more complex, but are they any more resilient? We have seen how a single ship stuck in a canal or a single pandemic can cause global economic whiplash. The climate shocks we face will be far more systemic and prolonged than a blocked canal. The Bronze Age collapse forces us to ask, have we truly built a resilient system, or have we simply built a more intricate house of cards on the same unstable ground? Rome LS story is a chilling historical precedent for our own debates on fiscal and monetary policy in an age of crisis. The debasement of the denarius in response to a shrinking real economy is a masterclass in how not to manage a systemic shock. It teaches us that you cannot print your way out of a crisis of real-world productivity. When the climate erodes the productive capacity of your agricultural land, your coastal cities, your infrastructure, no amount of fiscal stimulus or monetary easing can magically replace that lost value. It can only devalue the currency itself, destroying trust and accelerating the crisis. Rome's ghost whispers a warning to every central banker today. Your ledger must, eventually, reflect the reality of the physical world. The Norse Greenlanders are the poster children for stranded assets and the failure to adapt. The refusal to abandon a failing economic model, their inability to write down the value of assets that the climate had rendered worthless, is a story that should be taught in every business school. Today, our potential stranded assets are not dairy farms in the Arctic, but coal mines, oil fields, internal combustion engine factories, and low-lying coastal real estate. The financial system currently holds trillions of dollars in assets whose valuation is based on a climate that is rapidly disappearing. The silence from the Greenland ledger is a deafening cry for us to honestly and brutally reassess asset valuation through a realistic climate lens. before our own ledgers fall silent too. And the Great Famine of the 14th century shows us the terrifying speed at which a food security crisis can translate into a financial and social catastrophe. It highlights the inadequacy of traditional risk management in the face of true systemic shocks and the brutal social outcomes of a system without robust insurance or social safety nets. In a world where our global bread baskets are all subject to correlated climate risks, drought in North America, heat waves in Europe, floods in Asia, the specter of a global-scale food price shock is no longer academic. It is a clear and present danger to financial stability. The common thread, the ghost that haunts all these ledgers, is a fundamental failure of imagination, a failure to price in the non-linear, systemic risk of a changing environment. These societies were all, in their own way, blindsided by the speed and scale of the climatic shift. Their financial tools and economic models were based on an assumption of environmental stability that was revealed to be a fleeting illusion. Our task is to exorcise this ghost through foresight, not hindsight. This requires a radical shift in our approach to risk management. We must move beyond models that assume a stable, bell curve distribution of outcomes. Climate change operates in the fat tails of the distribution. It produces events that are literally off the historical charts. Our financial resilience depends on building models that embrace this uncertainty. It requires an honest conversation about asset valuation. We must systematically integrate climate risk into the price of every asset, from sovereign bonds to individual stocks. This will mean painful write-downs. It will mean recognizing that vast sums of what we currently count as wealth are in fact liabilities in disguise. It demands innovation in our financial instruments. The nascent market for catastrophic bonds and climate-related insurance needs to be scaled dramatically. We need new tools that can effectively transfer risk and fund adaptation and resilience on a global scale. We need to go beyond simply hedging risk to actively financing the transition to a sustainable real economy. And finally, it requires us to remember the most ancient lesson of all. No ledger, no matter how balanced, can stand when the society it represents collapses. Financial resilience is inextricably linked to social and ecological resilience. A system that generates immense wealth for a few while leaving the many exposed to the ravages of climate change is not a resilient system. It is a fragile one, haunted by the ghosts of Rome and medieval Europe, waiting for the shock that will expose its internal contradictions. The ghosts in the ledger are not there to frighten us. They are there to teach us. They are the accumulated wisdom of civilizations that face the same fundamental challenge we do today. They remind us that the climate is not an externality to be managed, but the very foundation upon which our entire global economy rests. It is the master variable. Ignoring it, mispricing it, or assuming it will remain stable is the oldest and most dangerous financial error in human history. Our challenge and our duty is to finally learn from their mistakes, to write a new ledger for a new climate reality, one that is not haunted by the failures of the past, but is instead built for a sustainable and prosperous future.